Hello friends, my name is Dr. Mukundkulkarni and I'm going to talk about data analytics used in life insurance today, has been used traditionally, and what are the future models which will impact the life insurance business. So I really would like to thank you to have shown interest in my presentation, and I hope that it will or it should add value to your current thoughts, processes, knowledge, as well as your current role. So I decided to really put this entire topic of talking about data analysis into a little structured agenda. And of course, to set the tone, I would talk about what exactly do we mean by data analysis from a definition perspectives, objectives, and when it comes to the purpose or why it should be a core activity in any life insurance business today. We'll talk about that in the introduction slide. Moving on from there, we would talk about the scope of analytics in life insurance, and I've kind of looked after this and thought after this for a long period of time and realized that it's good to bracket them or categorize them into analytics which are used for operational purposes, reporting purposes, business analysis perspectives which are more current factual data related outputs, and also put another segment of a high level use of analytics in creating predictive models, because at the end we are talking about life insurance as a business which is non-tangential, non-objective, and it deals with risk, and it also deals with very high variability. So it's a fantastic platform to apply predictive models and gain maximum information to be used in various processes of life insurance, whether it's pricing, underwriting, customer acquisition, marketing, sales, retention, or claims, frauds. So there are multiple domains in which predictive analytics can be used. We'll talk about some of them as even case studies in that section. Moving on from there, I thought it's very important for anybody to understand life insurance, to understand what exactly is the customer's claims journey or customer journey of insurance, which means how does the customer's lifestyle or the phase of life from acquisition or membership to the time when he either claims and or the policy terminates, whichever is earlier. So what exactly happens during the entire stretch or stage of the customer journey, and we will be talking about only those aspects of customer journey which are applicable to the insurance business. When I say applicable, it's both ways. Either it impacts the insurance business by either increasing or decreasing the risk or maintaining status quo as expected, and in the opposite direction, identifying opportunities for the insurance company to influence customers' life journey or the insurance life journey, which would mean we try and understand the customer on a very deeper platform and suggest or make operational changes or make operational ideas, create newer engagements with the customer to improve his journey. And when I say improve, the output benefit should be something which is favorable to both the customer as well as the insurance company, making a win-win situation. And then of course we will move on and talk about predictive models. Again, this is not a data science presentation, so don't expect any kind of technical content in a predictive model, though of course the model would mean that a very high level concept of a creation of a model, which would mean I'm only going to talk about a map. And of course, at the end, we will conclude, try and kind of collate all the discussion points and see whether it's really met the objectives of what you thought before you started hearing about this. So moving to the introduction slide, here we see a very classical definition, a very uniform definition used, that for data analytics is basically nothing but studying past historical data to research trends or potential trends, analyze the effects of certain decisions or events, or to evaluate the performance of a given tool or a particular event or a scenario, or as I said, even predict future events. And the basic goal is to improve the business, and in insurance, and specifically life insurance, though of course one disclaimer, I'm going to talk more about a general concept here, which would mean that though the title of this presentation says applicability to life insurance business, I'm sure most of these concepts are also applicable to other forms of insurance when it comes to non-specific concepts. So if you really see how does data analytics improve the business of insurance, I have tried and categorized those into 5 key parameters which we traditionally index as parameters of business improvements. And of course, the very first would be to improve the frontline business. Second would be obviously bottom line improvements. Third is improve this as customer satisfaction. Fourth is internal quality, because we're talking about insurance as a technical subject, so it's important for us to maintain high levels of quality of decisions made. And of course, also on an operational perspective, identify areas of prioritization or focus. So when you talk about the front line as such, it's like, how do we use data analytics on our current data, internal or external or third-party data, to bring in a model which will help us segment customers into people who are high potential to buy, as well as high potential to stay with the insurance company, which is going to help the distribution partners to acquire more frontline business. And of course, as a tangential benefit of this process, it would also make the company more closer aware about the customer needs, which would mean that there will be some additional cross-sell or upsell opportunities which is going to come up. Again, knowing the customers will also help us identify what are the kind of products we need to bring in, and that goes as a very good feedback, operational feedback to the product team sitting behind to build, edit, modify, or even remove the products which are redundant and not really helping much to our customers. And also, knowing the customers better would improve the risk management processes, specifically in all those processes which are selecting customers today, like underwriting or the transactions which are sensitive or suspicious, from the ones which are pretty much average or as expected from scientific, actuarial, as well as medical statistical methods, and we let them go, not wasting much time. And we even look at probably techniques to automate those processes from an operational excellence perspective. In the bottom line category, obviously, again, better risk management will improve the bottom line. It will improve the operational excellence. It will also improve the cost benefit analysis of, or it will feed in more inputs and information to cost benefit analytic processes, as well as assess any new process or assess any change in the current process from a CBA perspective. And at the same time, people who believe in outsourcing, value of outsourcing, can even data analytics are very, very much core to identify, manage vendors who are going to produce those services. And of course, there will be many other processes which will help improve the bottom line as the business moves on, or more data gets collected, or more analytical tools and methods are going to be coming into the market. because these processes will become much more structured, they'll become of high quality, and they will be much more faster, they'll be based on scientific guidelines, it will indirectly or directly improve customer satisfaction because of those things. And because we're predicting the risk and we're creating customer segments, it is as good as saying that we're getting much more closer to the customer, which is something which customer would definitely like to, specifically in long-term products like life insurance, where they would like to get engaged and they don't want to get into a feeling where once the sales process is done, the only engagement time is going to be claims or the time of maturity. And of course, it will also improve the quality control in any insurance business, specifically the review process or the auditing process, because it is not possible to look at every transaction from an audit perspective, specifically in high volume business cases or products driving high volumes today, and also in situations where there are multiple guidelines to be adhered to and there are unclear guidelines, there are gaps in the guidelines, and so there's a lot of moving parts here which affects the audit process today when it is done more on a human basis or a human sample basis. Now, using data analytics and using some automation methods with configured rules, business rules to it, technical rules to it, would also help take away most of the quality parts specifically related to non-cognition related decisions like process or low complex cases or low sum assured cases, and this will help even allocate resources in a much more optimized manner, and it will also help build authority matrices as per the competencies. So there are a lot of benefits of using data analytics in even the quality control segment. Last but not the least, definitely every company would like to have an operational platform which would or operational advisory platform which would help correct the current loss making or unnecessarily lengthier and effortful processes into something which are more smarter without losing any kind of value and making it much more faster. Now here is a concept where again, based on various parameters, and we will see in that in one of those slides, a customer lifetime value can be predicted or assessed or allotted to each of the customers, and company can then dedicate its efforts and money and time into only those customers. For example, we call them as platinum customers or gold customers to some extent, in to get maximum benefit out of the resource utilization as well as the customer average value which comes in. And of course, it can also help internally in business, whether it is sales, risk management or product development teams, to allocate more time and resource in those kind of products or processes which are going to be much more valuable as proven by the data analytical methods today. Okay, so before we even get into the data analytical part, the challenges associated with that and the benefits gained out of that, I thought it's important to understand the ecosystem where how the insurance company functions today, and what are the different factors, whether in an internal ecosystem which I've kind of highlighted into the in the blue circle on the right side, and the external ecosystem on the outer circle, which affects the insurance company functions. But whatever other factors, however dynamic they would be, it is important for every insurance company to make attempts to differentiate, because that would lead to much more customized offerings, whether it is in the form of products or services, and they should all contribute towards gaining that trust of the customer. Now, why is it important for insurance company to gain trust more than anything else? Because if we compare this with any kind of business where there's a tangible product, the value will also be associated with the product which is being sold. But in insurance, we are not selling any tangential or objective product, which would mean that because we are selling only a futuristic promise, it's important that there has to be a very high level of trust factor from the customer side before the insurance company actually tries to strategize. And again, another complication is the customers are never the same. The why we say that is because every customer has got his own variable personality, his buying behavior, his lifestyle. So the needs are going to be different at any period of time. So the strategy cannot be that one rule affects or one rule applies to all. And also complicating further, the customers keep changing. We see customers which were there a couple of years back in the past, and today's customers, there's a huge amount of changes which have happened. Today's customers are pretty well connected and they're pretty well informed thanks to the technology like internet, social media. They do have very wide choices because their buying capacity has relatively increased, and because of because of the more information available, more products available today, they can make wide choices. It's important that because it's a jungle of multiple or many options available, at the end of the day the customers will still value something which are suiting to their pretty needs. So they would need some product which are pretty closer to what their needs are. So the need for customization is still going to drive more weightage than new products or price competition or process efficiency or anything else kind of thing. And anyway, those processes or those aspects are going to be an offshoot of any good process or product which are customized to the customer's needs today. They also would value a lot of ease of interaction, which would mean specifically in stages where there is a requirement. For example, claims. They would love to have a very ease of operational interaction, communication, and process than anything else. So, frankly speaking, even if you would probably be paying them less than what they expected, because of whatever reasons, unawareness or not knowing, or it can be mis-selling, or it can be anything, or provide a controlled price, but very swift and a very swift transaction along with a good communication is going to ease the customer much more than it adds to the complexity if it is not swift or if it is not really looked after by the insurance company, leading to multiple complaints from the customers. And that's why it's important for the insurance companies to invest in building their own data lakes or databases from which they can actually deep dive and understand their customers in a much better way and differentiate customers and get customized processes and products to build trust. And the last line is something which I'm going to talk about even in the one of the dedicated slides, which is the care coordination. Every insurance company has to now down the line move from a typical payer platform to a partnering platform. What this means is, though contractually on a legal perspective the insurance company is liable to pay claims which are being agreed with the customer at the time of buying the policy, it still means that it is a much better situation for both the parties if they move ahead of those legal terms and start engaging at a much more holistic level at every stage of the customer's journey, which would help control costs as well as control the event, which is definitely going to be a win-win situation, because here we're talking about covering or financing those adverse events and not really happy events. Moving on to the next slide, where we're talking about the scope of analytics in life insurance. And as I said in the agenda description, here if we really need to see where all data analytics is going to apply or is going to benefit the life insurance processes today, there is no limit, and we can literally apply data analytical processes and gain value in almost every department or in almost every process. So it's a very crucial thing to actually categorize the scope of analytics into related brackets, and that's how I've done that, and I've made an attempt to put that into 5 brackets here. I would talk about the operational one, which is a traditional one, and in any business you would see data analysis is being used not only to understand how much productivity or how much time has been taken for a transaction, what level of quality as per the established guidelines and standards, whether internal, external or regulatory, and what level of efficiency has been achieved in any particular period of time. And you can even actually make comparisons to identify trends of each of those over a period of time. So those are more like an operational requirement of data analytics, and they can generate MISs which are either pretty standards as per the industry or mandated by the regulator, or it is something like a value or an internal framework which has been created by the insurance company themselves or their investing partners. Companies which invest in vendors and they find value from some of the perspectives by outsourcing couple of activities, and every company does have some extent of outsourcing agreements or arrangements in their businesses. Analytics can be used in many ways there. So one is obviously you can use it for the vendors who are already on board to monitor their operational processes, but before that we can also look at vendor selection from the databases or the information which has been given or provided before onboarding to make some scoring selections or unbiased selections. And we can also look at data analytics to drive the scope of services in the agreement with the vendors, because as I said, life insurance is something which is not very tangential or objective, and there's always a scope of identifying processes which is going to add value to the customers. So whether through a vendor we can add value or whether we should do it in-house, this decision can also be taken by a very holistic cost benefit analysis on those procedures or those processes or products. And insurance company can make use of extensive data analytics to identify and implement those processes. The most important, which is the interface, is the customer relations part, and analytics are definitely something which should be used here in the first instance by any life insurance before moving on to the other internal ones which we just discussed. Why? Because at the end of the day, customer is the one for which the services are going to be provided. So looking from a positive perspective, you can actually use data analytics, and that's what the next marketing and sales strategy is going to be, to make advanced tools usable for segmenting customers and helping the distribution agencies to understand the potential and propensity of the segments to acquire new business, as well as opportunities to cross-sell and upsell the products. And once on board, life insurance is something like it's going to spend a lot of money in the initial 1 year or initial period for acquiring customers, and it will lose or it will make losses if those customers don't remain with the life insurance period for a particular number of years. So it's important for life insurance also to focus on customers retention, and this is a big challenge because higher the competition in the market, higher the price competitions happening, more number of players coming in, specifically in growing market like India and Asia, you are going to find a lot of customers leaving the life insurance company, because at the end of the day their purpose of buying life insurance may not be exactly what has been proposed by the parent insurer. And of course the type of interactions the customers have. Now, as I said, we're going to talk about care coordination, where believe in partnering approach, where in every step the life insurance company needs to be interacting or engaging with the customer. There will be a lot of physical interactions or communicative interactions which will get captured today with the advanced technology available, and analyzing those interactions can really give a very good insight about the behavioral aspects of the customers and it can predict a lot of things about retention or fraudulent behavior or genuine behavior, or even further opportunities for cross-selling or upselling new products. And of course, customer satisfaction is something which needs to be prioritized in the form of data analytical output. The reason being, it is not only useful for the insurance company to understand the satisfaction levels with the products and the services provided, but it will also be becoming mandatory from a regulatory perspective to compare various companies based on customer satisfaction results. And traditionally, data has always been the core heart of risk management teams when it comes to actuarials who use data to price a particular product, or whether it's underwriting to look at better risk selection, or policy servicing to expedite and improve the operational efficiency in routine policy servicing related requests from the customers. And fraud, waste and abuse has always been a subject which has affected the industry a lot, and there has been very I would say relatively lesser successes against controlling them, and the industry still bleeds because of this, and there will be newer instances, triggers, and even concepts of fraud, waste and abuse coming up as we innovate in our processes, products and new services. So it's important to use data to identify a lot of things in fraud, waste, abuse, right from identifying triggers to identifying the investigational concepts or content requirements, extent also to kind of tap the third-party databases or industry databases or mechanisms to tap those. For example, scraping the social websites to find more information about our customers' behavior at the time of claims, or it can even mean an efficient resource allocation for the outsourced investigators when it comes to investigating cases with a potential fraud, waste and abuse component in that. Claims obviously is again the final output of any insurance policy, and that is exactly the purpose for the product to pay. And it's important for any insurance company to look after some of the benefits of data analysis in claims. Now, whether it means from an operational perspective to automate certain non-complex vanilla claims coming up based on certain defined parameters, or it can also mean looking at claims which have a potential for denials, whether it is based on genuine policy terms and conditions, or it is based on non-disclosures and other fraudulent aspects. So pretty much if you see, we do use data analytics inherently, and we've been using that in the past. It's not something which is special or a separate department, but it's just that kind of having a little holistic view as to where all there is a scope of application of data analytics, and then trying to make a business strategy to invest and to utilize the current resources or invest in newer tools and resources for data analytic purposes. This information is definitely going to be valuable for any insurance company. Of course, as I said, all these in an ideal situation would need sufficient amount of data, efficient data tools, and this is a big industry today, as to there's so many competitions in generating data tools, in generating so many advanced ways of assessing data today, and there will be advancing technologies to it, and there's a huge requirement of resources who are specialized in data analytics, like data scientists today. And of course, it's not going to be free of cost, and there needs to be some investment to in this area. And again, it becomes a integral part of the strategy as to how much you need to invest to gain maximum out of the data analytical support for any life insurance company. And of course, there's some of the things which will be regulated by the regulator, and as well as there'll be some mandatory things from a legal perspective which the company anyways has to do to maintain its license or legal status, which will also involve a lot of data analytical work. And there'll be advancements happening in data analytical work. Today we are looking at only using the current data, but we are advancing towards moving on towards using unstructured data, creating unsupervised machine learning models, using Internet of Things, and a lot of valuable information available there, as well as from a data security and operational efficiency perspective, use of blockchain technology. All these things are happening across all lines of businesses, and definitely insurance business and life insurance business within that is not going to be immune to that, and there will be influences. Now, whether it can be looked after from a positive perspective to find the benefits and apply those even in insurance, or probably look at some of the negative aspects of that and try and avoid those additional risks coming up with those advancements, is a call which the insurance company needs to take more from a strategic perspective. But notwithstanding that, today's case studies, and there are many influences of these newer technologies which are coming up, have definitely benefited a lot to the industry where they've been applied, and there also been some specific case studies where people are working on using these technologies in insurance sector. Let's move on and talk about the customer's claims journey or insurance journey, which most of the terminology has been towards using the term called care coordination. And let's talk about the concept, what exactly is the journey, points in that, and I'll talk a little bit about health risk assessment, because we are talking about segmenting the customers, we're also talking about selecting good risk, and we're also talking about managing those risks once the customers are on board. So as a concept, if you really draw a spectrum of somebody's life, and I would say a segment of that life is going to be the customer's insurance journey, you would see people who belong to, on the rightmost side, are the most preferred life by the insurance company, because they are kind of top fit people, ideal fitness people, and they have very high motivation. Their behavior is more towards being healthy, and they're well educated, and they kind of take this very seriously to monitor, enhance their health. On the contrary, on the left side, you would see people who have suffered from diseases, and as you move from ideal fitness more towards on the left side, you see they generally go through these steps, and some of these are pretty much obvious in the very initial stages if the person is aware and is reporting to the medical centers pretty early. But many of the situations, specifically where the services are not great and the awareness levels are low, you would see a lot of conditions today are getting detected when they're pretty late in stage. But from a insurance perspective, and we really look at this risk selection perspective, which we call as underwriting risk class, you see we can map those stages to the underwriting class which we build in our guidelines, and we operationally then make selection. So either we kind of accept them as standard rates for even people who have certain risk factors, but they're well controlled risk factors, and we do postpone generally or avoid risk where there has been an acute episode of a medical illness, but there is a possibility of a complete recovery or very low possibility of converting that into a chronic stage. And once a person is obviously terminally ill, we don't really insure them. Most of the companies don't do insure them, but the people who are already into the insurance policy, they then generally have to be looked after by the insurance company, which mostly doesn't happen in many of the cases. And if we really talk about what can the insurance company do at all these four categorized stages, is what I put those in red boxes. So for people who are healthy and they're highly motivated and they're preferred or more than standard life, we can definitely run a lot of preventative and promotive programs for them, which can be wellness programs. We can do the screening test as per medical guidelines available today, and we can use them as brand ambassadors. We can incentivize them, and in some countries we do have incentivization directly connected to their insurance premiums, but in other countries they do incentivize outside the insurance premium platform by providing them some additional benefits, or whatever suits them, kind of thing. And of course there can be a component of monitoring these people, because as I said, they don't remain, none of the person on this bar chart can remain at a particular location permanently. He will be moving more on the left side. Some people do move a little bit on the right side by improving fitness, but on an average you would see everybody moves from the right to left on this graph, and that is basically because of the geography, because of the demographic aging, as well as all those medical conditions related to aging. And people who do have early illness or an acute illness, where the risk is postponed when it is known at the time of proposal, but once the person is on board and do suffer from acute illnesses, if the illnesses are minor, then it may not be really impactful. But if the illness is a little major, I think it's time for where the insurance company to probably get into engaging with the customers in the form of either provider recommendations. They can do specific case management. That's where the medical experts from the insurance company would come into picture and identify what are the best possible medical protocol for that recovery to happen based on evidences, as well as there can be certain counseling and monitoring to take care of the psychological and motivational aspects for recovery. Now this is an important segment out of the four, because this is something which would have a high tendency to fall on the left side if not controlled. And it's not somewhere, again the concept is, it's not only the healthcare provider's responsibility to improve the health of your insured customers, and that's where the concept of partnering comes into picture. And it is also important for the insurance company, and it will benefit them if they invest a little bit in interventions at this stage to help people move more on the right side rather than moving on the left side. And of course, unfortunately, if somebody gets into a chronic stage or a terminally ill stage because of medical complications or disability, that's where you need to provide them support services, because there's a chances of complete recovery to a standard state is going to be minimal or very, very negligible. And that's where their requirements are going to be not really medical services, but more like rehabilitation services. And here are some of the things which the insurers can promote as domiciliary treatment, which will not only make the customers feel much better at home, but also kind of help reduce cost or control costs overall for both parties. So basically, you see in all four stages there are some things which the insurance companies can definitely intervene and do. Again, it depends on the strategy at various periods, where the insurance company should put it down as to what extent of services they want to provide for all these four categories of their customers. And for every activity or even building the strategy, it's important to have enough data on all these areas, whether the data comes from the underwriting part, or whether it comes from the policy servicing part, or whether it comes from the claims part. For recurrent claims, we can still have a lot of data which gets collected, or it comes from the industry data, external data, or third-party data. There needs to be sufficient data to feed into those strategic programs which the insurance company needs to do, because we all know that all these programs cannot be done by the insurance company. They need to create a prioritization matrix. They need to create things which are important, or things which are more prioritized to be invested in a much more scale than the ones which can wait for some time. And of course, there has to be a very exhaustive network of providers also. Here we're talking about the health of our customers, and there's another slide which I'm going to talk about what goes into measuring somebody's health objectively, and we call it as health risk analysis, or HRA score. And it's important that the services are provided by the third-party providers, which may or may not be in direct control with the insurance company, and hence it's important for them to have a very good networking platform, as well as service platforms, and they need to work jointly with the providers. They need to address the customer's requirement in a joint manner rather than piecemeal manner. In some countries where there is a complete universal healthcare model, there's pretty much integrated provider and insurance company platforms. But in some countries where they work completely independently, this is a big challenge, because based on the business needs, the agreements or the association of the providers with the insurance company, they differ a lot. There's a high amount of variability, high amount of complications, and high opportunities to misuse, and there are also gaps of services which can lead to medical complications and push our customers more on the left side. And of course, cost benefit analysis is a pretty much key aspect of every activity which has been selected as a part of strategy in care coordination, because at the end of the day, it is not something which we need to do to just create a non-monetary value for the insurance company. There has to be prioritization, and one of the key parameters to decide on the prioritization is going to be the cost benefit analysis of every activity selected in the support program. Now, typically, again, 4 stages of customer's claim journey, right from at the time of acquisition, which is highlighted on the pre-sales and sales box on the left side, to underwriting new business, or information gathered at that stage, or information gathered at the policy servicing stage, or at the end at the claim stage before the maturity of the policy. In every stage here actually gives an opportunity for an insurance company to generate specific data and important data. Now, this is basically an answer to the question as to if the insurance company wants to understand as to from where can they get data and which data points are going to be important. Now, this is the slide which says at every stage there will be triggers generated. Let's look at some examples. I mean, pre-sales and sales box, see exactly when we use predictive models to acquire customers, we do profiling of the customer, and this profiling is used everywhere, almost in all 4 stages. But the kind of profiling utilization of the customers at the pre-sales for customer acquisition, that's a very key information. What is the insurance need? What is the purpose for which he is buying? Now, whether he is buying or somebody is selling to him, how was the lead generated? What was the distribution choice of the customer? So there are many triggers which can be identified at the pre-sales and sales stage, and respective weightages can be given to each of those triggers, which will help the insurance company to generate a kind of risk score, and we'll talk about those risk scores in subsequent slides. And even in underwriting, there will be a lot of information, and I would talk only about one thing, which is more like the risk part, which would mean the medical information which comes in, and that is going to be the key thing to determine the underwriting class. And of course, there will be other fields also. So in all 4 stages, you'll have triggers, and I've also mentioned the data source from where those triggers can be identified. So look at this data source, identify those triggers, allocate appropriate weightage to each of those triggers based on the influence or interaction it has got, and then you can create what we call as the risk scores, and we'll talk about the risk scores in one of the next slides here. Now, as we said, health risk assessment is the key method in which we can assess as to how healthy our customers are from a very objective method. Now, generally, health is a very broad term, and it encompasses multiple dimensions. It's got multiple categories, multiple parameters which goes into it, and then it's very difficult to put it across as an objective manner for every process when it comes to interacting with the customers today. But from an insurance perspective, there are pretty clear guidelines which are built based on the products which have been sold and the pricing methodology the actuarial team has used. And to stick to those guidelines, the HRA for an insurance can present in a pretty much specific direction and hence it's important to understand as to what do we include in the health risk assessment from an insurance perspective. Now, what is it? Basically, it means it's a systematic approach to collect information which identifies risk factors, and it provides individualized feedback and links the person with at least one intervention, either to promote health, sustain function, or to prevent disease. Now, that's a classic definition of HRA. And when we really try and think about how healthy a person is, what parameters can go into, and how do we allocate weightages, we can still classify them into 5 categories. General categories are something which the person has got no control, and it's basically or very less control, and is basically an inherent factors like demography, geography, his overall financial status, and there can be others also. Social, yes, it's pretty much how he behaves. Lifestyle is pretty much what he does from his holistic spiritual life perspective, and psychological is how what kind of emotions, feelings he's got. So all those things which are definitely going to have an impact on the health. And when it comes to your insurance benefits which are tied to the healthy status of a person, the more it is tied to that, the more this is going to be valuable and applicable, the more the depth in which insurance company needs to go, or more frequent they need to do a HRA assessment to identify people at risk of claiming. So example is comparing health risk, health insurance with life insurance. So in health insurance, HRA is going to be pretty much almost a day-to-day assessment affair requirement. But in life insurance, we are trying to see only those aspects of the HRA parameters which are applicable to a long-term risk and not really a day-to-day risk. Of course, medical advancements are going to refine, create, and even delete some of the older parameters which are used as calculators to identify particular risk. So there are pretty much many calculators available today which predict a particular organ system risk or health. So CVS predictors, oncology predictors, dementia, diabetes predictors. Now these will generally use multiple parameters from the ones which I've listed here in the 5 categories, and would have some kind of weightages, we would say preliminary weightages already applied to them to predict, and these cannot be universal in nature. So we can use them from a preliminary perspective, but we need to refine them more from a customized perspective and try and create calculators which are more customized. And if you remember the first slide where I showed the ecosystem where the insurance company needs to differentiate and customize, now this is one area where an underwriting differentiation and customization can happen by using medical expertise as well as the available data to build in calculators which are much more specific and customized to the customers who are getting this policy sold to or serviced for. And of course, I mean, there are multiple health calculators available today. Okay, so moving on to a pretty much interesting concept called predictive models. And before I get into that, I think it's not something new, because some of the key functions like actuarial functions, the underwriting functions, and even many of the functions in claims are actually doing predictive models in their current jobs. Now, whether they're using data to a sufficient extent, or they're doing it more manual in nature, or by their own guesses, or by their own computations, or they're using some data analytical tools or not, that varies a lot. So the idea here is not going to be to bring in a new concept called predictive model as a new activity. It's a part of the inherent activity. It's just to talk about how do we really structure it like a data model, or using data and also using some non-data related events to create a predictive model which will help the insurance company not only remove the inter-observer variability or biasing, but also make it pretty much scientific to predict the events. And we'll talk about holistic ideal model, as well as then we talk about a couple of specific models. Okay, so using predictive analytics is key for any insurance company to determine what we call as customers' lifetime value, and this is much more applicable to long-term contracts like life insurance compared to health insurance, which is pretty much dynamic, and there will be expected fluctuation when it comes to short-term contract and use of this kind of scoring system or classification system in risk management practices. So in life insurance, because it's a long-term contract, it's necessary for us to kind of find out or classify our customers based on their lifetime value. So what exactly is this lifetime value, and how do we kind of derive it? If you really look at the scoring model outputs on the boxes below in this slide, you'll see different kind of scores which can be derived. Now you can have a customer acquisition score kind of thing, which gives you the propensity and potential of a customer, whether it's going to buy the policy and whether it's going to remain with the insurance company for a long period of time. And once we kind of generate leads based on this kind of customer acquisition scores, we can then use something called as underwriting risk index, which is nothing but how risky the customer is from the face value of the information provided at the time of underwriting. And so it can come from traditional underwriting data, it can come from some of the external data, which if based on the maturity model the insurance underwriting department works on for that particular product or for that particular distribution, and it can derive a comprehensive index about the extent of risk, so that we can call it as CURI, which is my terminology, but you can have different names for that. It basically says customers underwriting risk index. Once the customer is acquired, becomes a member, and all the interactions he has with the insurance company on the policy, which is generally tapped by the policy servicing department. Now either it can be the changes in member, changes in address, contact details, or some assured changes, change requests, or premium mode changing, with the multiple touch points where the customers can ask for some services on the policy, and based on the type of service requested or the kind of behavior the customer has displayed, and also in a active manner, insurance company can make attempts to find out the health status of the customer, either from a claims data on some other living benefit policies, or it can be from the industry databases, or it can be from the various value-added programs which the insurance company or its outsourced subsidiaries are working for the customers. There can be data and information generated. And also, if you really look at the customer satisfaction survey, can pick up some of the information which are hinting towards the risk parameters here. So all that source of information on the transaction as well as proactive data search can all be consolidated again into a risk score, and here we can call it CPSRI, Customer Policy Servicing Risk Index, and again it's something which will feed into the overall customer risk score. And of course, the most important one which happens is at the time of claims, but that's like in life insurance contract is not a multiple event, it is a one-time event, and it happens almost at the terminal end of the policy. Either the policy gets expired after the claims is paid, or the policy term expires. So basically, you can have some feeders there at the time of claims about what type of claim and what was the cause of that incident, or there can be a lot of other information available on the external domain, which can be consolidated into another claims index we call as customer claims index, or CCI. Now basically what we said here was kind of converting information into business rules, and that is the core aspect of predictive analytics. And once we have a comprehensive set of scores at all stages, and as you see, because these are time based scoring, so it will be dynamic, we at the initial stage, at least with the initial underwriting score, we can allot a kind of class to the customer based on customer lifetime value generated. So let's say here in this slide I've given an example of 3 classes: silver, gold and platinum, and what it means is the customers who belong to platinum kind of group can be either customers who are risky or the customers where maximum efforts or focus needs to be applied, and or they are customers who are generating more value by paying high premiums or buying multiple policies, or they're much better customers for the insurance company. And so we can basically define, and again this is different for different companies, there's no rule here as to what exactly do we want as a classification system for our customers. Whether do we want to have an operational classification system by segmenting them into segments which define the extent of efforts and services to be applied, and that gives a complete idea of the investment about the servicing content which the insurance company needs to apply. Or it can be based on pure risk, like in this slide, as I said. We prefer customers from platinum class because they probably carry the least risk of claiming based on the 4 risk indices we spoke about. After understanding the customer lifetime value and the classification which can be applied, let's understand a very, very high level basic predictive model. And in the introduction, as I said, this is not a technology kind of presentation, so don't expect any kind of technological solution or technological direction to create a predictive model. This slide will only talk about the concept of a predictive model. And typically, as predictive models are built in various types of businesses today, this also will not differ much from that. So you will have data sources which are kind of labeled on the top. They can be internal data sources, and if that's not pretty rich, you can still look at the external databases available or third-party databases, and there can be others. Now these data have to be obviously refined, prepared, key variables need to be identified, a little bit of initial explorative data analytics to understand the trend, understand the spread, understand the distribution, and of course apply certain data transformation methodologies like feature engineering and categorization, managing those missing values and outliers. So these are traditional data preparation or data transformation methods which are used almost everywhere in creating any predictive model today. Now what differs here is basically as I go back into the data sources which are specific, and again those are dependent upon the extent of data available today in the market as well as internally with the insurance company. Now one point I would like to talk about is, though the typical process is going to be the standard process of modeling, integration, evaluation, and then pilot deployment, review that in a full deployment kind of thing. What is important at the time of integration or the time of creating the ideal model for a predictive analysis here is we need to also incorporate a little component of data independent factors. What it means is, because it's a business, it deals with the risk and it is not an objective assessment possibility. There can be variations at an individual level, there can be variations at a group level, geography level, at multiple levels, and it is very closely connected with the health system and the healthcare services available, as well as it is also connected to the medical advancements and its impact on individual health today. So it is not possible to assume that the data is a true reflection of the health risk indices today, and that is why there will be gaps. These gaps have to be looked after more from a guideline perspective, and that's why even if the data is exhaustive enough, we would still like to integrate a couple of data independent factors which are clearly scientifically proven by the clinical community today in the form of guidelines or policies, regulations, and even by the insurance regulator who is making it mandatory or is making it to be adhered by the insurance companies on the risk platform. They need to be integrated into the model. That's important, and we'll see for various specific predictive models these data independent factors also become very, very specific. Once we have that, obviously the concept is to convert all that information, unstructured, structured, or the wider subjective information into a kind of objective platform of output scores, and we can classify them the way we want. I mean, a very simplest of classification would be to classify these into high, medium, or low as far as the scores are concerned, but you can even combine 2 or even 3 factors to get a 6th grade or a 9th grade kind of output scoring system as a final output information from the predictive model. And obviously data analytics will not have any value unless it gets converted into any kind of business rules or operational processes, and that's why the core idea of converting this output score information into business rules, which will be a kind of suggestion which is more scientifically driven, which is more database, which is more guideline adhered to, and which is pretty much I would say unbiased, because most of the times we see in a non-data analytical scenario, it is more on the experience which are gained by the key people in the organization which drive the operational suggestion. But here we're trying to bring in the unbiased platform and trying to drive scientific data driven suggestions. Those suggestions can definitely be like, if the scores are high, let's say we have a model where we try and focus, promote, and prefer, like we said in the earlier slide, more like platinum customers need to be engaged pretty much in a very different way compared to, let's say, low score. We'll try to avoid those risks, or we'll try to create triggers or alarms before we really conclude that these are some things which are avoidable. And obviously a major segment of the risk will come into the middle zone, which will be medium, and this is where you won't have a clear answer from an operational perspective, but you may definitely have answers to defocus or focus or optimize your efforts towards the various subsegments of the customers. So this is a high level idea about or concept about a predictive model, and what we'll do in the next slide is try and pick up 1 or 2 examples of how this can be applied to those specific processes. So let's look at how we can apply the same concept for the risk underwriting process. Typically, why this is important that we use predictive models for underwriting is basically, obviously, it will help us triage and segment our customers much better, which would mean that we would clearly expect or would also kind of operationally optimize our efforts towards customer engagements if we have a good system of triaging based on the objective risk parameters. And of course, because we are optimizing our resource allocation, there will be cost reduction, there will be efficiency, and obviously inter-observer variability is also going to be minimum, and hence standardization benefits are going to come in. And at the end, it will also lead to a better customer satisfaction, because customers who need services are being given services to much better extent than a random choice. So what will differ here, or what will be specific here, will be the data sources. So if you see, typically all those data sources which are needed to create an underwriting predictive model would be more like the demographic data, then the financial data, which is credit information, and the most important for life insurance would be the medical information or the health information, past history, family history, social information, and others. There can be many. Now here is where the richness of the model will ripen. The more you have the data getting into the model, the more valuable data is coming into the model, the better will be the output kind of thing. So the flexibility is directly proportional to the amount of data available as well as the value of those data. And typically, again, like the model structure is, we need to identify traditional versus non-traditional variable parameters and try and weigh them as per the as per their impact on the final output score, that is CURI. And we can do categorization, we can play around, and this is where the domain expertise will come in, and they will kind of help with not only the data related results, but also their own experiences, because sometimes the portfolios cannot be a true reflection of the overall portfolio. And that is where the subjective expertise to kind of modify the weightages, modify the selection of variable parameters, and also include some other parameters, like we said, include some of the inbuilt calculators or inbuilt or the guidelines, which are more on the data independent kind of factors, medical guidelines. Now, one example of medical guideline integration would be a lot of medical developments happen on a day-to-day basis, and our underwriting guidelines cannot be updated at the same pace as what the clinical guidelines are coming up from authorized institutions of the world. What the model can do, and there should be an attempt to capture as much as official changes to the guidelines happening in the medical world and try to kind of integrate that, and that is the model deployment can allow that flexibility much more than compared to a complete underwriting guideline revival or renewal kind of thing. And of course, product guideline also. So all those guidelines which are data independent factors need to be integrated, and the final output here, because it's an underwriting prediction, is going to be a underwriting score, and that will be an underwriting risk score, and we call it as, I call it as customer underwriting risk index. And I can, again, as I said, have 3 classifications. I can decide as to what should be the cutoffs for each of those categories, and then decide what is high, medium, and low. And if CORI is high, and I will kind of say that these customers are much more safer, and I don't want to waste so much of time and effort and money in underwriting these cases, so probably these are the cases which should ideally be accepted as a state 2 process, and this is where the triaging is going to help. Now, more than the actual decisions taken by the predictive models, most of the companies who have deployed this model today are using it more like a triaging system than really a decision making system. Makes sense, because that's more of an immediate operational benefit than a long-term value-based technical decision made benefit on the decisions part. So for a new company or a company doing this for the first time, or trying to still struggle with the CBA part on the predictive model, they can utilize this predictive model only for operational triaging benefit objective, rather than a complete medical underwriting automation system. But the companies who are confident enough, with sufficient experience of managing predictive models in underwriting, with extensive data and guidelines getting integrated in a dynamic way, they can expand the scope even to taking underwriting decisions for those cases where the scores are less than high, like medium, I would say, and low is pretty easy, because these are very clear cut outliers, or we can not outliers, but the ones which don't fit into the underwriting guidelines, and that needs to be denied very clearly and very easy to justify also, because that's what the policy terms and conditions, or the agreement terms, or the legal terms in the application form would clearly define and protect the company from any kind of contest in the future. Now let's look at another example, which is how to use this predictive model for customer acquisition, and this is obviously much more applicable to the sales team who would like to understand as to how they can use data to improve their sales process. Obviously, using predictive models in sales platform would benefit, because they will be able to identify the customers who are much more higher in buying propensity or staying propensity with the insurance company. So the front line is going to be a first major benefit, and obviously the quality of risk is also going to be better, because generally we see that insurance is a kind of product where the customers are hesitant to go and buy. Very few customers generally do that. It's generally sold. So if you really segment the customers pretty well as to who needs it more than who don't need it, then and actually get those on board as per those classification, the quality of risk is also going to be much better. Yeah, and one of the bigger challenges in sales is to optimize the time and resource availability versus the kind of business they get and the extent of business they get in. So, resource management optimization for sales managers is definitely one of the big benefits by using predictive models in customer acquisition. Now, if you really see the same concept applied here, what changes is again the data, the data source. I meant that. So a very rich data source or an ideal data source should have the psychographic component of the customers, which would mean their behavioral aspects, their lifestyle aspects, their buying behavior, their healthy or unhealthy lifestyle indicators, their shopping experiences, and of course you can actually even do surveys, and we do surveys generally, and that becomes a data source. So it's not something new. People do surveys to understand the customer segments, and that data is also going to be important. The one which is upcoming and which is going to improve or increase further is going to be scraping the social data to understand the customers even better, because the intention of posting those kind of posts on a social data is very different and not connected to an insurance buying behavior. Compared to, let's say, a survey information, where there will be a little bit of biasing because they know the purpose of the survey by the person who conducts the survey and which domain he belongs to. So combination of these kind of data is definitely going to be important to create a rich predictive model. Again, I would repeat that the output of the model is directly proportional to the extent and the quality of data available. So the more you try and scrape the social data, for example, the more you have psychographic data available, the better is going to be the propensity and potential scores, which are the outputs of this model. And again, nothing different in high-level concept or steps of the actual modeling steps. And you need to still identify the traditional, non-traditional, weigh the variables and find out the dependent, independent, and do a little bit of explorative analysis, manage the outliers missing. So traditionally the same thing. Now the specific thing in here about the data independent factors which needs to be integrated along, and this is going to be much bigger in scope compared to, let's say, the underwriting prediction model or the claims or fraud, waste and abuse prediction model. And the reason I'm saying that is because most of the data, if you see, are external in nature. And because the external nature, they will be of very unstructured format, they will not be uniform, and they may not be valuable to the complete extent. So there will be a high amount of data independent factors which need to be looked after in this kind of customer acquisition model. And the other big challenge is even those data independent factors would be external in nature. So for example, industry database, I can give an example of MIBs in US, which are medical information bureau data, or the common motor vehicle data pool in India, which can help understand the behavior of the customer. Of course, they are connected to some different line of business, completely not live, but let's say a driving behavior from motor claims data available today can give you an indication about the overall or a very high level aspect of the personality of the customer you're talking about. And again, because everything is external here and it's not really we call it a validated platform, important to, from a business strategy perspective, give weightages based on the product. So product specific weightage can be another factor which can be applied or integrated into the model. And of course time specific weightages, because over a period of time people would have from an experience would have realized that how the insurance sales change as per the time in a year. And in countries like India, where the financial year ends at, let's say, the March 31st every year, the last quarter is always something which everybody sees a big increase in the sales, and there is a high possibility of substandard lives also getting sourced there. So typically the insurance companies would have a historical experience based on the time during sales, and this is something which needs to be converted into an objective calculator. So we can give weightages as per the experience, which can become a big important data independent factor. And of course there can be others. And again, here, because we're talking about the possibility of customer buying and remaining with an insurance company, so we need an output which is more like a propensity or potential scores allotted to each customer based on this model, at the back end. And again, we can classify them into high, medium, low, and all those customers who are scoring high, which would mean that they have high propensity to buy and high potential to stay, kind of thing. So they can have dedicated engagement strategy for them. And somebody who's scoring low, we may still sell, and if people are still buying and monitor them, but we don't want to really spend so much time with them, kind of thing, from a strategic perspective. And obviously the major segment in the middle, we need to still look at some deep dives and kind of integrate other strategies like product strategy, or even the time strategy as to when do we want to approach these kind of customers with what kind of products, and what is the ideal sum assured or size we expect from this kind of thing. So everything can be a combination. An operational suggestion out of this course coming up can be a combination of either a level 1 suggestion, which is pretty much straightforward, like in high scores, you straight do nothing else, don't waste time, just go to the customers and try and sell some products to them. Or for the middle ones, we can do a little more deep dive and kind of integrate other strategies like products and time, and then bring out a operational plan. So that is how the customer acquisition predictive model can work in life insurance today. Let's talk about the fraud, waste and abuse model. And here again, I'm not going to talk much about the benefits, because everybody knows that fraud is a big leakage today. And if you have good technical scientific way of predicting those frauds, you'll obviously contribute towards the savings, and obviously you are bringing up some bad cases out, and you're spreading that message across industries. There'll be reputational benefit, cost reduction, and obviously good genuine customers will be happy with the way the company is managing their books. So there'll be higher customer satisfaction and efficiency. Those are very, very much unsaid traditional benefits coming out of a model which can predict much more cases of fraud, waste and abuse and control them. The specific data sources, and here the weightage is going to be high for the claims data, past claims data, and the cases which in the past have been identified as fraud, and the triggers which have been identified as fraud and effectively resulted into a conclusion of fraud, and the further actions on the claim. So all those are going to be very, very crucial data to train the model. And underwriting POS data, and we spoke about those scores like CURI, CPSRI and CCI. So those will have the parameters which will we can identify those parameters which are towards the fraud, waste and abuse category, and even allocate specific weightages to them as per the experience, or otherwise as the way experience has come out of the data. And of course, most of the countries do have, or the regulators do maintain an industry fraud list today, and we can have that as a direct match with a high weightage, even because that is something more specific, and we don't really need to predict them because they've already kind of created a baseline, and any customer mapping or matching any of those behaviors which are created in that will definitely need to be treated as a a high fraud propensity customer. There can be frauds which are provider driven or third party driven, and there you need information or data from the third party or the providers, which also again need to be integrated into the model with specific relative weightages allocated to them. Coming to the data independent factors, which in fraud again may not be, because we don't see frauds in high volumes, and that's why the model may not be, if the model generally is training better on high volumes, this is going to be a little difficult one to get trained. So it's important again to have a good amount of the content of data independent factors built in. It's pretty easy because most of the companies do maintain a particular fraud trigger list with specific weightages given. They are using this to some kind of fraud triggering mechanism, may not be predictive, but fraud triggering mechanism, they're definitely using that, which is very much the same concept here. It's only that you need to integrate this aspect with a lot of other data related inputs to create a completely holistic predictive model. Of course, every company does have an anti-fraud policy mandated by the regulator in every part of the globe today, the anti-fraud guidelines. So we can pick up variables or parameters from these guidelines and fraud trigger lists, and also industry reported frauds. And there's so much of publishing in the media, so much of publishing in the courts cases and all that, which also determines. So basically it should be an aggressive database of fraud triggers or fraud cases or fraud parameters being published everywhere. Needs to all be consolidated and put that as a data independent factor in the integration of the model. These are not something which will be featuring in the data of that insurance company used to create this model, but they definitely will support the model weightage or model scoring process. And of course, again, the output should be a fraud propensity score, and we can have our own terminology here as to, let's say we divide this into high, medium, low, and high propensity scores. It definitely would mean that the case is highly likely to be a fraud, and we may probably deny the case, we may do more investigations, we do legal action, a lot of things which are operational suggestion coming out of it. And the ones with very low propensity score, probably we don't need to spend so much of time and money in investigation. That's exactly what can help improve the bottom line by not only eliminating the potential fraud cases, but also reducing the expenditure on the investigations to identify those fraud cases. And again, the big segment in the middle, we can probably have different different intensity of watching them or monitoring them by creating watch lists, again based on the propensity score. So higher propensity scores within the middle zone probably can be watched with a higher frequency and much more intensity than cases which are at a lower fraud propensity score in the same zone. So that's about the predictive model for fraud, waste and abuse, and it's not specific only to life insurance. This can be applied anywhere, and the only thing what changes as per the domain where it is applied is the data source, the data independent factor, and the way you convert information into business rules. So we spoke about an ideal model, we spoke about 3 examples, one underwriting, the other customer acquisition, and the third one was the fraud, waste and abuse score. There can be many other opportunities, and what I felt according to my experience and thought I've listed down here, but there can be obviously more than this, and the insurance companies obviously can, and they are moving and they will move towards using technology to predict the outcomes on all these domain requirements today. Many of these requirements have been traditionally either predicted in a manual fashion or predicted in a non-data related fashion, and there has been a huge component of inter-observer variability and biasing based on the experience of the person handling that particular function. But having a predictive model based on a rich data, integrating with non-data related guidelines and all, is a holistic solution which will reduce those biasing and inter-observer variability and be more scientific and evidence based. So to summarize, data analytics and life insurance is definitely a key function. The only point here is it can be a dedicated unit, or it can be almost every department investing some time and money into the analytics, but it is definitely a key function, and it is more aligned towards predicting risk related events, should be more aligned towards predicting risk related events. It clearly benefits insurance at all those 5 categories we spoke about: front line, bottom line, efficiency, quality and customer satisfaction. Yes, the major challenge almost everywhere in the world today is availability of clean, useful data to sufficient extent and volumes. It's much more challenging for in growing markets compared to the mature markets, but there is a huge potential for data analytical applications in the entire insurance sector, including the life. The key aspects of data analytics, as we said, is the availability of data and use of those variables, the dynamicity of the variables, and the number of iterations or updations of that model which needs to happen then respective weightages which are allocated based on the experience, and this is again not a scientific experience, it has to be driven by experts and then monitored over a period of time to make those refinements, and then it will become a person independent kind of approach towards weightages and becomes more scientific and objective in nature. Because it is such a key function in almost all functions of insurance company today, and the needs are going to keep increasing and the complexity is also going to keep increasing. For example, today people are talking about scraping social data and converting that into a lot of objective scores in their maturity models. So it's necessary for every insurance company to have a very clear data analytical strategy in their company. Now, whether they have a dedicated unit or whether they don't have a dedicated unit, but a dedicated strategy is definitely the need of the hour. And that strategy should include the data management, the legal aspects, then the variability factors, the weightages allocated, the model creation and their different updated versions, the integration of regulations, and also use of the competitive information available in the industry to make the best use of the data analytical functions today. And lastly, data analytics and predictive models need to be looked at supporting and not really replacing key risk functions like underwriting and claims assessment. Now there's a thread, people keep talking, a lot of posts on artificial intelligence, machine learning related developments which will probably replace, and we are talking about automating a lot of functions, which would mean basically it should replace a couple of manual functions today. But ideally speaking, it's a way we approach this function or this development. We ideally should be looking at using this kind of expertise in supporting our risk management rather than replacing the risk management. Again, because life and health risk management functions are pretty much subjective and every person comes with a variation, it is necessary that though it provides a data rich platform for analytical methods to throw outputs, but it also means on the other hand that there needs to be experience based approach when it comes to deciding on the risk decisions for those kind of customers. So I myself personally feel that data analytics and predictive models should be supportive and not really a mechanism to replace key functions in underwriting and claims assessment. Thank you very much for being a patient audience for my presentation, and I have mentioned my contact details on slide number 1 as well as the slide. I would really love to hear from you on the feedbacks, as well as if you have any questions or doubts on this presentation pack, or you need to connect with me for anything further. I'm very, very happy to respond and interact with you guys. Thank you so much for attending my presentation today, and I hope you liked it.